Hello, welcome back. You're listening to The Royalty King. Guys, please like and subscribe because if you don't, my next guest is going to sweep you from half guard and he's going to catch you in a guillotine. My guest today is Trader Ferg. Joining me, we're going to give some commentary, or Ferg is going to give some commentary around the commodity prices. The only thing hotter than the weather right now are the commodities. And we're going to talk China, emerging markets. So strap yourself in, take some notes. I'm certainly keen to learn. Ferg, how are you, mate? What's happening over at your part of the world?
Oh, not a lot, Ben. Yeah, good to be back on. At the moment, just battling the rainy season. Just like dart to a cafe or try and get the little guy to preschool before we get dumped on by monsoon-type rains. So that's the main aim at the moment. And then it's extremely humid and muggy in between. But yeah, other than that, just staring in amazement at some of the commodity prices at the moment. Feeling a bit uncomfortable sometimes when you kind of, some things I thought were the more conservative of the portfolio, you just open up and see it doing something even more crazy every day. And you're like, oh, how do I de-risk even when my kind of fundamental view isn't even really underway and I'm seeing this sort of price action? Yeah. When I kind of viewed it as something like just the physical platinum ETF, that was like 5% of my portfolio. And I kind of viewed that as kind of was going to be a boring grind higher. And here we are with it doing sort of crazy stuff. Was it PPLT? And it's, and the premium in China isn't going away. It just seems to just bounce around high teens. And with that not being removed, like it seems like it's still got legs. So yeah, it's a crazy time.
It is a crazy time. You and I were chatting about things before we hit the record button. And you mentioned like you're getting to this point where a given position in the portfolio is done really well. But now you're asking the question, okay, well, if I were to sell that and allocate it somewhere else, where would I allocate it? And so if we, I guess, take a step back and look at the commodities complex at the moment, as far as I can tell, the only thing that hasn't really run might be oil, obviously. Iron ore is not exactly expensive. If you look out at the moment, where do you see the most asymmetric opportunity as of today?
It'd have to be oil. Yeah. If you want to go right down the most hated area would probably be seismic, like of oil. Like if you go through oil, like you've got, I think I've run the charts before, like just ratios. And if you compare something like just big oil producers, something like XLE, then I just like to run the ratio because it just makes it a bit exaggerated. But against something like NASDAQ, then for oil to get back to the oil producers to get back to their all-time high, you'd be looking at sort of a 7 times return. Then if you go up to some of the midstream via XOP or even some of the Canadians, you're up around the 10 times. And then if you look at one that's just been absolutely wrecked as services, you're up around 50 times, which just shows just how absolutely ruined they got from their peak in 2010, 12.
And are you using the broad sector ETF for those calculations?
Yeah. And I'm using equal weighted. It was kind of important. Like you won't get those if you use something like OIH. Obviously has a really heavy weighting to the big boys like Halliburton, Schlumberger. But if you use something like XES, then you're limited to 5% per position. And if you compare that to some others that you can use so XOP is also equal weighted. That's midstream producers. And forgetting what the Canadian one starts with Z, you can get equal weighted Canadian as well. Okay. And compare those and then taking it, because it's kind of where I like to hang out, just looking for absolute roadkill. Say like what's the most hated within the services, and then you obviously end up in offshore. I can't even show an ETF of that because it got delisted. It got dumped at the post Liberation Day, and you got something like seismic, which is just the sector's just all gone bankrupt and been absorbed and been merged, closed, whatever you want to call it. It's just been carnage between that and the offshore, particularly the drillers. It's just been absolute slaughterhouse.
Yeah, it certainly looks like all these signs of all those contrarian indicators are in. I think the only thing we're missing is for like Time magazine or something to say that oil is finished or oil services are finished. I mean, if that comes out, it's like, wow, that's
Yeah.
every bucket ticked. So we're thinking more services, and is that based on the theme that in order to get more production onto the market, obviously that capex is going to be the income for these types of plays? Is it a case of trying to be long the capex as opposed to the producers? Is that part of your
Yeah.
thinking as to why you're positioning down in the services?
Yeah, I've got a piece and like I've only wrote about a quarter on it, but I really want to flush out the difference between being long capex and long just straight the oil price. Like you've also got pros and cons of both. Like if you get a geopolitical sort of outcome, like another sort of like Russian invasion type, then you really want to be long like Canadian. Like you've got a way more torque directly to the oil price, so that's a big winner. But if you actually just pull up oil services like XES and compare it to the oil price, it's been running hard for the past ever since Liberation Day. Like it's that gap has really opened up, and quite a few points to dig into with it. Number one is you're benefiting from gas as well as quite a bit of spending in a lot of the gas infrastructure. So a lot of these are kind of benefit from both. You've got my theory is just the space has been so decimated that it's just a shadow of its former self. So any capex squeezing into it has a far bigger effect. I just wrote a piece for my pro subscribers that was looking back at, if you go right back to 1998, it's kind of interesting to do a little case study there in that the IEA was predicting an oil glut back there, and
What a
which never
surprise.
eventuated. Yeah, like right back. Like I don't even thought of taking it back to 2007 when I was trying to work it out forward. But if you go back 1998, they thought there was an oil glut and didn't appear. In the end, there was Asian growth surprised the upside, which has just been this like constant. Is they never see it coming. They get run over every time by growth in Asia, and so it's kind of interesting to see the strength in oil services and wonder if that's what we're actually seeing. Is it's almost a canary in the coal mine for capex really starting to kick off that no one picks up on because the agencies are all blind to it and squeezing into a small sector. This would be confirmed by a lot of the little places I like to hunt, all these little kind of, I call them like searching for a pulse, and all these little Asian oil and services, and a lot of them are just look for a few of the charts and they're just spiking. And um, it'll get revised in the years to come when they finally get their numbers. Like there was actually a big inquiry into it by US senators asking how they could be so bad at forecasting and how they miss it. And then anyone that's followed Go Rosen's work, he's like documented them just missing it by just under a sort of a like ridiculous amounts. I think it averages out to 800,000 barrels a day from 2007 to today that they've
Yeah,
missed.
didn't they say
Yeah.
if you calculated
And
all the missing barrels, it would end up being like one of the, not the top producing nations, but the surplus of missing barrels?
18th
Yeah, I want to say it was
largest
in the top 20. Uh,
consumers. It's just, yeah, so I've still got to flesh out the whole, but yeah, that's kind of what I'm working with. And it also ties in when you consider we've got dirt cheap oil, which in itself translates to like oil and GDP growth are tied at the hip. So if you can have dirt cheap oil, then that's going to obviously have an effect in Asian growth, which is really the engine for global growth. So you're giving them cheap oil, you've got a weakening dollar. And even if you get a strengthening dollar, a lot of this trade's now being done outside dollar. So
right.
because you used to have, if you'd ever have a crisis, you'd have oil plummet and you'd have the dollar jump up. And so that would slam a bit of a handbrake on the effect of cheap oil because they still had to source their oil using dollars. And now that handbrake's not there because they can source, they can do deals in their own currencies to get access to it, which is China's promoting hard. And then there's a few other things like I've written about why I think there's an Asian bull market coming. You've got China lending at like half the cost of pretty much all the Western lenders. You've got some really interesting little like signals around the place. Like everyone should look up what Fortescue's doing. They just got debt from a Chinese lender for 5 years. It was 3.8% for 5 years. And the Australian government can't even borrow at that. The Australian government's 5 years, like 4.5 or
Yeah,
something from memory.
it's crept
Yeah.
up. It's knocking on
Yeah.
the door of 5, or perhaps that was a 10-year. And I
Yeah.
really want to get into the Asian markets. And before I
Mm,
do, I've got to ask you this question. This is the question I get asked the most about what my thoughts are about this idea of, yes, there's been a dearth in oil capex, as in
mm,
liquids, but we also have had a very strong performing natural gas price. And so which school of thought do I belong to? I belong to the school of thought that says crude oil capex is down, therefore crude oil is going to have to go through a bull market, or do I take more of I suppose, the Doomberg philosophy that co-production dynamics really matter a lot more than they ever did. Refineries are more able to use more of these liquids. There's a lot more, I guess, fluidity between hydrocarbon sources. So if you have a gas market that goes bananas, then you're going to have an increased supply of liquids, be they NGLs or be they crude oil. What say you, Ferg? Where do you find yourself in these camps when the battle lines on Twitter are being drawn?
yeah. So at the core, I think a lot of extrapolations have been drawn from lower Asian Chinese growth. And so that in itself is misleading, because when there's lower growth, particularly in China, then it allows these extrapolations of this is why they're consuming, they're weaning themselves off oil. There's more gas trucks, there's more EVs, like an over extrapolation of the effect they're having, where like Anis Al-Hadi's done some great work on this. He thinks of what they're claiming as a reduction in oil is actually only probably less than a quarter of it is relating to like LNG, LPG trucks and EVs.
Okay.
It's actually all to do with growth. And so growth is what is holding it down. Particularly like the LNG trucks is kind of interesting. I've really dug into that. And that was more just an arbitrage that's really faded recently, because, and it kind of gets overemphasized, because when that made sense and there was a real spike in LNG trucks was just when it made sense. There was a bit of policy support to it, but all the diesel trucks, the older, less economic, just get put on the sidelines. And when growth comes back, they all join the fleet again, and
Okay.
you're back to growing energy demand. And it's the same with kind of misleading to look at what the ratio of energy consumption is on a low growth year, because renewables will take up because you can't dial them down. Like it's generally just your oil consumption or your coal consumption that you dial down. Whereas when it comes roaring back, it's all oil and it's all coal. So that's the first big one to touch on. I think there's just a an sort of underestimation of what the mix would look like with a higher growth environment. And I think we are going into higher growth, particularly across all of Asia, for the points I just touched on. Like it's going to be a kind of put it in the recent piece. It's kind of like the offer you can't refuse. And I've got Xi Jinping at the head of a table from The Godfather, and all the countries lining up to kiss the ring, because he's going to offer you cheap capital, cheap energy, all the processing, the manufacturing, and when it deals in your own currency. When you look at it like that, then I don't see why there won't be sort of just a massive, why there won't be a big burst in growth and GDP in these countries. Like what's really holding it back? And then going on to the like the whole NGLs, that's interesting in itself, because I only just started digging into that. But what it looks like's happened to me is China's increasingly cornering processing, and in particular petrochemicals, because petrochemicals, so refining's been a terrible business and a lot of them are going under. The older ones can't compete with the new ones that are coming on. But petrochemicals was quite profitable. And so that's how they cushion their margins. But China's pushed into that and really done what China does best and undercut a lot of them. And so that's been slowly killing off the profit margins, and even the super cheap kind of petrochemicals in US, which if you go right into they've had a massive competitive advantage because when you're making plastics, you get ethane, you get that straight from shale. That's like the cheapest feedstock, whereas China has kind of been weaning themselves off it. So they've been really focused on petrochemicals with naphtha, and it's harder to compete with the US petrochemical industry. They just have scale, size. They've financed all of the new refining capacity around the world, and they're like cornering that. And they're also, which is the most interesting, they're kind of slowly weaning themselves off the need for ethane imports. So they've said by 2028, I think it'll be almost negligible. They'll take it from, I think it was like mid to high teens, they'll take it to low single digits. And so they would, because the US tried to weaponize it on them for a while with the imports, ethane. And I see that kind of backfiring because I see them not needing it. I see shale economics running into some issues, just similar to what happened back in the 70s and 80s, where it'll just get harder and harder. You'll have worked through the tier 1 onto the tier 2, and you have to spend more and more money to extract. And it'll be more difficult as China does what China's doing and has cornered a lot of the processing, has encumbered a lot of refining around the world.
Where's the Chinese refining power roughly around the world? So their refining abilities, where have they put those? On mainland China, or are they kind of doing the
majority is mainland China, but all the additions, I've got a great chart of it that you've got pretty much the vast majority of the additions by US has been with some sort of a JV financed by China,
right.
And the ones that have been getting killed, the Europeans with their older, it's similar to coal in a way. Like I talked about coal, where the Europeans patted themselves on the back for shutting down all their coal capacity, but all their plants were like 40 years plus. So it was like, well done, like shutting down this old inefficient. And they were like kind of pointing like, we shut down our coal plants, you shut down your coal plant in like Asia, where the average age is like 13 years old. Like they're all far more efficient, new capital that isn't anywhere near having had a decent return on capital. And so, yeah.
So that's where the refining capacity is. What about the feedstock? Like, where are they planning to get most of the, well, if you're talking ethane, I guess, gas? Are we talking pipelines still from the east?
So they're still importing, I think the breakdown would be, they'd still import 6 to 8% from the US, but if they couldn't get a hold of that, they would just dial up naphtha, because to produce ethane, you can use naphtha. You don't have to use ethane. It's just ethane's far cheaper and more efficient to produce it. But it comes with a whole lot of there's a whole essay on this because it's actually kind of really complicated. I've only just been digging into it. So I haven't even built out the whole mental map in my head.
We'll leave the thermodynamics for another chat. Yeah. Okay. I get that.
And they do have some, and they do have some of their own internal fields on it as well. I don't think it's very much, but yeah, the key point is naphtha comes from just the processing of crude, and they have encumbered an awful lot of oil supply moving forward, which is kind of interesting when you look through all their oil for loans, all their, like what's happened in Iran that people can't seem to kind of understand, is that sanctions don't work because it's all done sort of off the system almost. That's a huge amount. And they're just playing. I always love the sort of people claim some of the US moves as 4D chess. China's been playing 4D chess. It's been planting all these seeds for years. Like I think I've got a chart that of their consumption. Was their consumption? I think it's 15, 16 million barrels a day. I think they've got about 6, maybe even 7 encumbered. So they've already locked it up in loans, JVs, financing, the finance something so that they get 100% of the offtake. It's the Craig Tyndall's piece, The Return of Matter, digs into it. He doesn't touch on, I wish he'd touched on the refining part. He more touches on processing with commodities. But yeah, I think the refining part's largely been missed. I haven't really seen any commentary. And trying to research it, there's not much research out there at all. Yeah. If anything, there's just the opposite side. There's the Doomberg side. I've got like a got like a file on my computer that's got roast chicken, and it's just going through each point by point that I disagree with.
Okay.
Yeah, I think like with Doomberg, you can even search for yourself, just search his views, the pieces he wrote on oil, just run it through an AI, and he's very pro-cyclical. So his first piece was like $300 oil when oil was high and went higher, and then he um, still put out a bullish piece for oil when it had already rolled over, like end of 22, maybe in 23, and then when it had come right down, got quite bearish. So yeah, be interested to see what happens when where I think energy goes in the next year or two, whether he comes around and gets bullish again. But I just
Yeah,
don't
well,
think it's how you
certainly,
make money.
yeah, well, I'll certainly have him back on to ask because I respect both you guys and your viewpoint.
Mm,
So you're bullish China slash Asia
mm,
and emerging markets, and you mentioned quite a few of those factors for why that's the case. I'm going to throw another one. You touched on the dynamic of the US dollar, and as we know, a lot of these emerging markets have US dollar denominated debt. When oil's cheap, they can use more oil. Obviously, that creates more demand for those dollars, which strengthens the dollar. And then that acts as somewhat of a handbrake because their own individual national debt situation just simply doesn't allow for that extension of GDP growth by energy
mm.
consumption. What
Yep.
happens now when we have essentially the stated objective by the Treasury Secretary of the US saying that they want a weaker dollar due to their own fiscal situation? How much of that goes into your thinking around the picture or the setup for GDP growth in emerging markets? Do you think they can really burst through the ceilings of the past with this kind of dynamic?
Yeah, I do. It's like one of my core kind of views is the fact that we're going to see there's just an awful lot of tailwinds for a lot of these developing markets. Because what you touched on there is kind of important when you consider it's like kind of the analogy is probably like having the forced saving from your salary. Like if you have like kind of like almost a tax, like you have 30% taken off you for retirement, saying it's got to sit in an account, you can't touch it unless it's an emergency. That's what's kind of been happening across the developing world. Is they've always had to have a pile of US dollars so that they can access the commodities they use, and that the fact that that pile's just got to sit there and is a drag on their ability to grow. Whereas if they can just instantly do deals in their own currencies and access the commodities um, more easily, then yeah, it's going to be a huge boost to their ability to grow, get what they need. Economic growth is essentially tied to your ability to access the energy and increasingly the commodities and critical minerals and manufacturing you require. Because it's another thing that I always kind of have a gripe with is there's almost this sort of thinking that when you look at what's not manufactured in China, like you look around the developing world, it's like an alternative to China, when the vast majority of it is assembled from Chinese parts. Like you can declare, you can declare something is made in, like it varies between some of the countries, but I think across the sun, I want to say it's like north of 40% can be directly sourced from China, and you can still claim it was
Yeah, Australian
made,
made or whatever the
yeah,
case.
Australian made, or yeah. So it's yeah, and yeah, you're seeing this really, like China is in such a good position when you consider the amount of monopolies they have on. I was just looking at the transformer market, and whereas they're all sourcing them from Western companies, all the inputs that are holding them back are they can't expand their manufacturing base because they're relying on a few Chinese parts. They need was it goes grain orientated electrical steel or nose non grain orientated, and I think that's 72% controlled by China. You always get down to a point at which there's a bottleneck with China. I kind of like the analogy of like China can just turn up inflation in the West whenever it wants, just has to slow down a critical supply chain to them. It's like if you ever had like we had a flat where if anyone used a sink in the house, you get burned in the shower. It's kind of like that. They can just crank the sink and hear the scream if they want. And you've got that across all these industries. If they don't like how some US automotive producers competing, they can just make a part really hard for them to get and just cook them. Yeah.
Yeah, that's an interesting point. How interconnected and fragile the global supply chain has become from, I guess, 20 odd years of globalization, right? So I'm going to ask you the same question that gets asked of me when I talk to a particular guy that asks me certain things, and I give them certain reasons and all this kind of macro overview. And at the end, he says, that's great. How do we make money from this? So there's a
Yeah.
question of, it's fascinating, the points that you mentioned. How are you positioning your portfolio to take advantage of these, what certainly sound like longer term trends in capital allocations around the world?
Yeah, it's obviously I'm big on commodities. I just don't try and be too smart with, like, you'll never catch me like hanging out in futures and trying to do some sort of bond spread or like that. That's just ultimately, I just want to keep it as simple as possible and try and drill it down to where is where is there a big supply and demand imbalance. Ideally, the demand no one sees coming and the supply is in a really bad way, like PGMs. Granted, it's a bit sort of redundant now because it's taken off and the asymmetries, like I wouldn't be allocating capital to it now. The more I'm just kind of standing by with a knife, like thinking, is there a better use of this capital with what it's done? But I see, yeah, just kind of like it's almost like whack-a-mole. We're just going to see it move right through the commodity spectrum. Read an interesting piece by Lewis and Zagava, which was kind of like the idea that with what's going on with Trump and the Fed independence, everyone kind of can almost see inflation's going to be coming down the tunnel at some point. Like he's gonna cut rates because of necessity. Like they've got no other lever to pull. He can't touch entitlements. He's talked about increasing defense. So interest rates are really his only lever, and he's going to pull that lever regardless of the inflation risks. Even if inflation's starting to rip in his face, then they'll still pull that lever. And so once you understand that dynamics in play, then you just start storing your purchasing power in commodities, and the order of operations would be the cheapest to store. And so that's exactly what we've kind of seen. You've seen like gold rip first, silver, platinum, like obviously precious metals, highly value dense. And then you slowly move out the spectrum till you get right to the back end, which would be like softs, which are obviously perishable and cost a lot to store. And so we'll probably keep seeing that order of operations. And so by that logic, you see how we've seen gold first, silver, platinum. I love rhodium. Then you see the industrials like tin, copper. I think uranium is probably next in line like that. That makes a lot of sense. And then you'd have energy kick off, and then you'd have ags really kick off. So that's kind of just a mental framework. Yeah.
Okay. With the uranium spot versus term dynamic, how do you see
Hmm.
that playing out? So it's not the easiest commodity to get your head around, and I suppose that you're still playing this via certain developers, or you think that there's now some kind of disconnect between the spot versus the bigger players in the space, or is it time, God forbid, to go into some of the explorers in the sector?
No, you won't catch me in too many of them. The way I view it was
Come on, mate, where's your sense of
that
adventure?
lost a few years ago along with a lot of
A
money.
few bear markets ago.
No, the way I view uranium is it's funny because I think kind of like, you know how gold bugs got such a bad name up until recently, like, oh, here's another gold bug just explaining, like what they're explaining was right. It's just been nothing had happened for so long that it was almost like become a conspiracy theory. I feel the same
Yeah.
as uranium. Like I know a lot of smart people that can explain the uranium thesis, and I'm like, that's spot on. That just hasn't arrived here. The utilities haven't been forced to contract in size. Nothing of what you've said has been incorrect. It just hasn't occurred yet.
The
And there
price
will
action hasn't
be,
confirmed it, right? Yeah.
yeah, there will be a point at which, similar to there being, I think John Borsoff a long time ago used like, what will people pay for the last liter at a gas station when everyone's got to get to the airport for an international flight? Like it's that sort of dynamic. And I've said it on dozens of podcasts, but here we are with contracting in 2025 with still like 50% of utilities replacement rate. Like it's still, they haven't showed up, but we know that they will because it's a small proportion of their operating cost. Honestly, the mining space has been kind of a disaster if you judge miners by their ability to get it out of the ground, not to what they're promising. Like you've got some US where they're getting judged on nameplate capacity and ability to market or ability to produce rare earths, or like there's been lots of successful uranium's performance-wise, even if you go into the SMRs, but production-wise, there's been very, very few. Even Cameco, granted, it shot the lights out, and maybe I'm just angry. I didn't just play the thesis simply and just sit in Cameco and close my eyes. But there's I think someone put up a meme of like a magic trick, like don't look at like Cigar Lake and our production over here, look at our future ability to manufacture nuclear plants. And so when you go through the mining space, it's just been disaster after disaster. And what's particularly interesting is like how ISR is now, I think it's over 50%, and the amount of promises that have kind of fallen on their face. Like you've got to look at like the likes of Boss, where it was supposed to be just a clean, smooth ramp up, and then you've got all these other promises across all these other ISR projects. So obviously Cameco's had their own fair share.
How did Denison end up with? They were supposed to use that where it hadn't been used before in Canada, right? Like, did they ever make that work?
I don't own Denison, but that was always, I think they were supposed to come on. What is there? I think they're coming along 27, 28, aren't they? So I haven't really been tracking their progress. The one that I look at occasionally is Peninsula, and just see them promise that this time we've got it. Don't worry, this time and then they just dump a whole lot of like their business model is literally just selling shares to people that haven't done any DD.
Well, they're not the only one in the space, to be fair to them.
No.
So how do we? There's so many minefields, and it's such a beautiful thesis, but it's filled with problems. How do we avoid the dilution dump? How do we be exposed to the sector? Preferably not via continental Africa.
You got there as well. Yeah, well, the way I approached it really was just heavy physical. If I want to really talk it, that you've now got the options on the physical that got launched in September last year, which is a pretty nice pure play. And then I went for, I just believe there's been a lot of over contracting in a regime that won't reflect the future regime. For the sort of band that you had a lot of contracts done. I think like Encore's really shot itself in the foot, like fully contracted out, and even going to struggle to deliver. And if prices really step up, then they won't be taking.
Yeah, that's taking advantage the other way around, right?
Yeah. You're kind of you're selling yourself as a sort of a talk to the thesis when you've kind of sold away all your talk. Yeah, just makes no sense to me at all. So the ones I went after were the ones that ideally hadn't sold any, hadn't signed any sort of offtake agreements, and yet they had a good sort of resource base, and weren't issuing too many shares. So yeah, kind of like just avoid the middle of anyone in production, and with the view that, similar to John Borstoff before he stepped down, he was kind of just pulling the fingers at the utilities, saying like, I'm not signing an agreement till you, I see prices that actually make sense for greenfield economics. And I think you want a bit of positioning in those, and the rest physical. I still think price is going to go somewhere crazy. Like I think absolute, like for the supply to come on, you're at least talking, I think I've talked before, like a sort of a floor of 120, ceiling of 180. That's like the absolute basis
for terms we're talking.
Yeah. The term for a decent amount of, because you're also, this is going to be happening at the same time that a lot of commodities are ripping, that they're competing over the skilled labor, and all the skilled labor's like left this sector a long time ago. Even as I'm talking about John Borstoff, he's like retired and hope his health's good, but he wasn't exactly a picture of health guy.
He was an absolute specimen.
Absolute specimen. But yeah, when he eventually kicks it, like, God, there's so much knowledge and skill that's just going to go with him, and he hasn't really had an understudy because they've like been, as I was saying before,
market.
Yeah, that's just has been a real drain. So yeah, it's something to really keep an eye on when any sector you're looking at is like, what is the timeline for skilled labor to get trained up? How many of the inputs of China have they encumbered? And that doesn't mean just direct control. That means, have they financed it and agreed to the offtake? Do they control some of the inputs to it that they could slow walk? And then the energy aspect as well. Kind of like all this talk of like the AI the grid build out, well, a lot of it just doesn't actually make sense. Like the power coming on, most of it's solar, which isn't going to help with that. The
No.
grid can't take it to get the grid where it needs to. All the infrastructures in China, again, come back to the slow walk. You're going to have all this copper smelting. You're going to have to, yeah, I could just go on and on and on, which is why I think there's going to be a big gap between, it's almost like a, there's almost like a clean analogy between like paper markets where when you've got a market in a surplus, you can play all the paper and financial games you want. But as soon as that goes into deficit, then physical's in the driving seat. And we feel like we're just crossing that now where physical's in the driving seat. And so we're just seeing paper realize that it's got no claim on the physical really, unless it reflects reality, which going back to like just probably taking the analogy too far, that margin between COMEX and China futures is like that gap is between reality and no one's wanting to recognize that in the West for now.
Yeah, I think the silver shorts will have learnt a thing or two about paper versus physical at the moment with what we've seen in that market. And let's
Mm.
say these terms get signed, it doesn't mean uranium magically comes out of the ground. I mean, it's going to take a little while to get this back into production.
Mm.
If you had to estimate kind of the all-in sustaining cost at the moment for the current producers,
Mm.
where are we at in terms of most of the more efficient producers now in terms of a pound of uranium?
Well, I tracked Chemico for a while, and they no, sorry, not Chemico, Kazatomprom, just tracking there because they update it yearly, and it was I think that's up. It's up well over 100% since I first started tracking it in 2020, and it just jumps and jumps and jumps, and then you also got the chart of how heavy their decline rate is through the 2030s. If you is the fun little exercise to do there, where their cost has got to and how much. Like I think it was Riaz Rizvi, let's say he was the chief operating officer. There's been so much staff turnover at Kazatomprom, I can't keep track of who's where. But
Yeah, they need
he
a
was
new
saying,
recruitment agency.
yeah, I think he was saying maybe mid 2030s or even 2040, they need another two Kazatoproms. That's what the market requires. And yeah, they're like the bear case for uranium was that like Kazatomprom would just be able to flood the market with cheap uranium. So yeah, already there. All the sustaining cost is doubled, and they've got this facing this almost shale like rollover. Yeah, I'm not too concerned. I'm happy sitting on my physical and see, yeah, like I said before, a floor of, I think a floor of 120 minimum. And you also got to say, like, what's the dollar going to be worth when we're talking about this? Because
Yeah, exactly.
it's like just run a what do you call it, like inflation calculator for what $100 bought you pre-COVID and today. You're if you had a billion of capex that you delayed till today for 5 years, then you're going to have
Yeah,
to come up with
it's
a
going
bit
to cost
more
you a
now.
little bit. Yeah.
Yeah, and can you get the inputs as well? And then that's before energy runs as well. If you got everyone should run a chart on the diesel input for extraction cost for commodities, just to get an idea of how damaged margins could get if we really see oil run.
Yeah, well, that's why I like to stick to royalty and streams if I can get it. In the uranium space, is not really the same in that aspect.
No.
In terms of, you mentioned, okay, you've got a rough price in mind, and that's a moving target for
Hmm.
uranium. What about PGMs? It might be a little bit trickier. At what
Yeah.
point, let's say you wake up one day, at what price would you start to say to yourself, you know what, maybe I'm going to roll some of my physical platinum into another opportunity? Yeah. Have you thought much about what that might look like, or is it just today where we're seeing the metals rise so quickly that it's really a moving target?
Yeah. So my issue in terms of portfolio allocation was I came into this quite heavy with energy. So I've already got a lot of energy. That said, with I see platinum going an awful lot higher. My sort of framework is it'll look a lot like the 2000s. So yeah, from the bottom to the top, you're looking 6, 7 times. And when I would start to look at trimming it would be seeing a decent supply response out of the South African producers, which at the moment isn't really happening. I think if you if you bring up Impala, Valterra, and Sibanye, I think last year anyway, I think only Sibanye increased production. The others were largely negative. And so a lot of this crazy prices is yet to even bring the supply response. And so then it just becomes a question of like, is there an opportunity cost to staying in this trade versus moving it somewhere where there's just an awful lot more asymmetry? And I am moving some capital across to new portfolio, which is going to be more income focused. It's going to be exchanges, some more industries. Got some interesting angles like China, mining tech stuff. But yeah, for now, I haven't really trimmed any PGMs, and I just see there's such a scarcity and so confined within South Africa as well. Because a lot of the longer term forecasts, they're actually taking in what North Nickel's bringing on.
I was just going
And
to ask if let's just say the war ends tomorrow and sanctions are forgiven and magic wands are waved, what kind of influence can the Russians have bringing more metals onto the market? Or have they already kind of been doing that? It's just been kind of swept under the rug.
no, so they've been delayed. So they've got, is it Torsk Free, I think is the big expansion project. And that would potentially add 8 to 9% to global PGMs. But that comes with a big caveat in that they are extremely heavy palladium, and they're like when you have PGM deposits, yeah, all the platinum and rhodium heavy ones were pretty much just in the bushveld in South Africa, and they've been heavily depleted, and so they've been forced to move north, and even Zimbabwe and Russia, and they're all quite palladium heavy. So by default, that puts real strain on the platinum and particularly the rhodium. And then on top of that, North Nickel, its PGMs are largely negative cash because its main economics around its nickel, obviously in the name, and copper. And so, well, where it is a decent revenue driver for them. It's not the ultimate. It's kind of like this whole byproduct kind of economics. Like, again, coming back to that return of matter, Craig Tyndall does a great dig into it, is you can have prices get really out of whack when you're dealing with byproduct economics because it's not the driving factor. That's why I'm so bullish on rhodium is economics of rhodium don't really drive its supply side response because it's usually such a small part, like using North Nickel, like they wouldn't really care. It's like 2% of their split. So no matter what the price of rhodium does, it's such a tiny proportion. And the same with the likes of Stillwater in US, that's palladium heavy. The likes of Zimbabwe, that's palladium heavy. So the rhodium split, like whereas in the bushveld, you can get rhodium splits up to 9% of the deposit. The rest are all 2, 3. And so it's not
And
doesn't drive the
when it
economics.
comes to the substitution more so between palladium and platinum, how do you see that playing out? So, okay, maybe the new production is palladium rather than platinum, but those two are more closely interchangeable. No? Okay, rhodium's a little bit different, but you don't see any threat with a substitution dynamic happening eventually?
Yeah, so they can substitute because they back, it was Sibanye helped fund it, but they, with palladium really outperforming, and particularly with the whole Russia situation, there was an ability to substitute platinum into catalytic converters, and a lot of that's been locked in. And so, interestingly, that kind of has been put into processes which is not easy to reverse, and now platinum's run hard. So, it's actually a good point. I should research what is the ability to retool back towards palladium. I don't know the answer to that. I just know
I
that
just remember
there was.
looking at charts where palladium was a lot more expensive than platinum, and that led to the dynamic which you mentioned of, there was a substitution, and then obviously that's starting to play out on the other side here today as we look at platinum taking off. The only thing from memory that platinum can do, palladium can't, is in medical instruments, and because there's obviously like a germicide thing that they need to.
There's a lot of industrial inputs as well.
Okay.
And you got the whole refining, hydrogen even. Yeah, no, it's got a lot more uses. And the big one is there's a lot of the investment, that's where a lot of the, if you look at platinum for a few of the YouTube channels, they didn't really see the rally coming is because they didn't model in any investment demand. And so they just got absolutely run over when it goes from like nothing to the Chinese started creating 1 kg platinum bars. And that was a big part of why it ran to start with was there just wasn't enough when you added the investment side to it. It wasn't actually industrial ramping up or catalytic converters. It was just the investment being added to demand.
Okay, so you see the industrial wave of demand is still to come then, based on where
Yeah,
we are.
if you look up the World Platinum Organization, they were really negative. They were like seeing industrial down 19% year on year. I think this year's forecasts have dialed it back a bit, but yeah, for tied to, because it's interesting if you look at platinum, you can almost run platinum and the emerging market boom, the emerging market index over the top of each other from 2000 to 2008. It's the same chart, and so yeah, I kind of see that you're going to have a lot more consumption on the fact that internal combustion engines and hybrids are here to stay. We're seeing the straight battery electric really starting to stall out. And yeah, I just love the whole trend. I think there's coming back to one of my first points was I always get asked why I'm not like all over copper. And it's just because who doesn't know the copper thesis? Like everyone knows the copper thesis. Like just open my like any news scanner and there'll be some CEO saying how they're kicking out their PGM and their coal assets to focus on the future, which is copper. And I'm like,
Yeah,
all
whenever you see
things
Kamal
equal.
talking about something, it's it's a
Yeah,
sign.
yeah. Yeah, I love that. Was it that was Shrubs, and then whoever I can't even remember. Maybe his name was Jason or something, and he was just like, "Whoa, copper!" Like I'm like, okay, like when the tech bros even are all over it. Yeah, I prefer to hang out and stuff like. I still always use like rhodium and tin, like just guys where it's just a few of us in our underpants talking about it on Twitter, and then that's the entire community.
Yeah,
No one
and
else kind of
so
cares about it.
quiet.
Hmm.
Okay, so you like platinum. It's going to take a lot for Ferg to let go of his platinum. You
Yeah.
mentioned tin, and now we're talking about Asia and commodities being a great way to play that Asian boom, the Asian century. Maybe Jim Rogers will be proven correct.
Hmm.
Commodities have got to find their way to China, and that has led to some people in the past to talk about shipping as the bottleneck. That's a business that always was run by pirates, and still today, as far as I'm concerned, is run by pirates.
Yeah.
You got any got any shipping stocks for preferably not domiciled in Greece, if I might be
Yeah.
so
Yeah.
specific?
That's fair. I'm pretty boring with shipping, really, in that I just I like the order book setup. I think there is inevitably a bull market. The only question really is there a when you talk about the ability for a supply response, I kind of put VLCCs in front of the likes of offshore rigs and stuff. Like there's just more. There's a higher ability to bring them on. You never underestimate how much China could ramp. So I want to go with the most constrained asset. But other than that, I think you can't beat just plain old VLCCs, like just was it DHT, where they own 26, pure fleet.
Yep.
You get paid a nice dividend.
They dish
So
out
even if, yeah,
98% of what they earn every quarter. Yeah.
yeah, like I love that. And I subscribe to a few kind of insiders that I'm just terrified of missing either a VLCC bull market or a cape size, like dry bulk. Like if anyone's ever watched those in the past, they are coming down the pipeline at some point with how small the order books are. But yeah, not smart enough to see them. I just would like to at least have maybe jump on a few longer dated options on the likes of DHT Frontline even, or for the Cape size. Yeah, some of the dry bulk names. Yeah, so I don't have any of them in the portfolio, but they're definitely very high on the watch list.
Okay.
Mm.
And in terms of, you mentioned drill rigs, but what about jackups? Jackups, where would they, how much does it cost to build a new VLCC versus a jackup? Because those things normally can get onto the market more quickly than some people might expect.
Yeah, well, that's the thing. There's still capacity to build them. Like, there's been a few delivered recently. Granted, you do fine. Like I think like a lot of this is just splitting hairs between value guys that are
Probably.
we're just talking about something that's been in a bear market so long that we like to get into the intricacies of it, but it's all going to do fine. I obviously stick with drill ships because I see the fact that I think it's at least 5 years to build a drill ship. It's highly complex, very expensive. You're not going to get the cheap finance for it anymore. Like they used to sort of throw around 10% deposits, where now they're talking more like 40. Everyone's been burned from them in the past. Like a lot of them are still like just getting them out of their yards that sat on them. And so I subscribe to a few like Asian oil and gas news sites, and when you read between the lines, like we still can't get easy finance in oil and gas because the banks hate us. They've all still got memories of us like just lighting money on fire. Like one of my bigger positions now was like this little OSV company with a shipbuilding arm that went bankrupt twice. Like everyone, it's just like or like the likes of Seadrill bankrupt twice as well. Like when you get in something that's gone bankrupt twice, wiped a whole lot of people out, there's a lot of people that will have PTSD from that name and not want to lend to it, or like when they come around again. So the economics will have to be like just crazy to justify. And that's part of the whole thesis is you'll have this window where you'll just get fantastic returns before they can be cyclical service companies and destroy their own economics again because they overorder.
Yeah, that's right. Well, ships use a lot of iron as far as I'm concerned. Iron compared to, you mentioned copper and some of the other commodities that we've spoken about. Maybe we can kind of bring it home here talking about iron ore and coal. Okay, so two commodities that, don't seem to be particularly popular at the moment, and yet they would be a big part of this commodity slash emerging market boom. How do you see iron ore at the moment, particularly, with Ukraine being was the third biggest producer? They're obviously not troubling the scorers anymore. What's going on with the iron price?
I don't know if I've got any great insights other than I was ever particularly interested in iron ore just because it was the whole sector's hasn't been short of capital. It's done like I love stuff that's been in a bear market for for the better part of a decade. Like if you look at oil and gas, it's been capital starved for a long time. Whereas I don't like if I'm going to go after the dynamic of iron ore and steel, I'll play it via met coal or coal. Like I prefer somewhere where I feel there's a lot more constraints, a lot tighter supply demand, a lot more hate. Like it's always funny that no one really blinked an eye about investing in some of the big miners, but as soon as they have some coal exposure or talk about coal, then it's kind of evil. And so there's definitely a lot of information in that. Coming back to like the copper story with I think Anglo's been one of the greatest. Like you would have done fantastically last few years if you just sat in cash and just waited for them to spin something out and then just buy it. Like you would have got Fangella, you would have had a 10 bagger within a year or so, and then they would have spun you out Valterra. Granted, I'm not very bullish on diamonds to bears. I think China's properly ruined them with that was just a fantastic marketing operation for decades. Yeah, I think they're well and truly screwed. Had someone ask me the other day if I consider getting long diamonds now that they hate it, and I sort of said I'd already done my ass because I've bought my wife a big diamond, and I asked her the other day if she'd take an artificial diamond. She'd be like, sure. And I was like, oh shit. 5 fingers down the toilet. Yeah.
Well, you never know. The babe might come back. It might come back. You can do the old sneaky switch in the nighttime or something like that. Okay.
Yeah.
Look, mate, it's been a fascinating conversation. Anything we haven't touched on that you wanted to cover today? We've covered quite a bit in the commodity space and Asia, particularly Southeast Asia, heavy.
Last one's just exchanges. I'm just writing my piece on at the moment that just kind of view them as absolutely beautiful business models. Got this analogy at the start of the piece that's just viewing a nice highway with a toll gate on it, and kind of right up there with like payment processors or software platforms where you've got the claim of being like just a one of the nicest business models in the world, and as they have been, if you were in playing them on the likes of like NASDAQ, which is a lot of people don't realize that if you bought the NASDAQ exchange rather than just being long the NASDAQ 100, you would have actually outperformed it from when it listed. More interesting to me as well was periods when inflation reared its head, the exchange outperformed while the index got smashed. And so that in itself is kind of interesting because of the whole capital light business model. And so where I think the big opportunity there is just kind of using the analogy of a highway with toll road. I just see there's a whole lot of these beautiful highways around the world where there's no cars on it. And I think we're going to see cars in the future for the whole Asian boom that I've laid out. I think there's quite a few emerging markets that'll benefit from that. And also the fact that the whole currency drag is no longer occurring. A lot of people run the DXY just to illustrate how strong the dollar's been, which it makes a point. Like if you run it from 2010 to today, granted it's got a bit weaker recently, but it kind of topped out sort of 50 to 60% higher. And that would have obviously punished you if you were overseas, when you could have done that sort of returns just being in US dollars before, considering all the outperformance with the US companies, particularly tech. But their DXY is what, 60% euro?
Yeah, it's basically the pound and the euro.
Yeah, and a bit of yen. But yeah, overall, like it's really just a developed country basket. So if you run a lot of countries I'm looking at, they've been far more creamed. I think of a dozen, like the average strength of the dollar against them was about 80 to 90% over the last 10 to 15 years. And so if you've seen that turn along with money starts coming out of the US, particularly tech, then you've got one hell of a tailwind for a long time. And these are like a nice way to get kind of currency diversification across developing world. Because a lot of people also balk at the fact of, well, that's fantastic that you're saying like a whole lot of small Asian currencies and developing country currencies are going to start to outperform. But I'm like not comfortable allocating the whole lot to I don't know, the South African rand or the Malaysian ringgit, or like, and so just having a nice spread with great business models and high dividends as well, a lot of them, is super attractive, I think.
Yeah, as I mentioned before we started recording, that's preaching to the choir. I've set up a whole portfolio around that. And, for those dynamics that you mentioned around the Forex, an increase in volume obviously is one key input into the business model for these guys. So the more volume and the more volatility that happens in the world, as far as they're concerned, the better. I'm not sure if you've seen, looking through some of the CME's results around new products coming on to their offering as the exchange, particularly around, say, cryptocurrencies and Bitcoin. And obviously they compared then the appreciation of the asset, like gold, crypto, how much the asset appreciated annualized, and then the volume of the contracts traded on the asset. And it was like a factor of like 5 or 6 in some of the cases. And so not only do they get access to new products appreciating in price in and of their own right, but then you've got all these different derivatives being layered on top of each other. And what are the risks for this type of thing? The only thing I can think of is if, and obviously I hope this doesn't happen, if there's a severe global conflict and they shut down trading for several months or something like that, it would have to be pretty bad, and we'd probably have other concerns on our hands. But what other risks have you been able to identify with these types of businesses?
Yes, there's a few risks. Like you've obviously got what happened, like a little case study is Santiago Exchange. So if they go hard left and scare away all international investment in the exchange craters, like there's just the equivalent of like the toll road example, and then just like saying screw you, like it'll go from $5
road closed.
The road's closed. Yeah, or just officials at the front asking for bribes or something. Yeah, like there's that sort of a that's just like you kill the liquidity, you kill the exchange. So you've got that dynamic, but I don't think that's as much of an issue with. I feel like we're going towards a lot more right leaning. So that kind of, and particularly in South America as well, that's quite interesting. You've got the risk, which I kind of keeping a close eye on with a lot of like the blockchain. Like you've got the whole like the decentralized. Could all this stuff be nabbed away by some new decentralized low cost exchange, could they kind of just come in and absolutely ruin some of these supposedly quasi monopolies? So there's actually a few examples to keep an eye on the US. I think I want to say it's the Nasdaq, or it might be the ICE, but they're starting to incorporate some more blockchain initiatives. The ASX tried it and they absolutely did their ass on it. They lit, I think, 250 million on fire trying to install blockchain.
Yeah, you got to be really happy with the technology, but before you roll it out to such a big
Yeah,
scale. So there,
yeah,
there is that.
yeah. So no, and there are competitors. Like an interesting one to watch is what is it? There's a new exchange launching in the US. I want to say it's like might be getting it wrong, like Florida or Texas or so, no, Miami. I think it's Miami.
MyX is floated, and
MyX,
Texas
that's it.
Stock Exchange is now floating as well due to do an IPO.
Yeah, yeah, yeah. And so to watch the uptake of that, does that eat into what's quite cool is you can be positioned in a lot of these because they're so capital starved in a lot of the developing markets, and then you can know what to watch for, what plays out in the US. Like, okay, this business model isn't as robust as I thought it was. But when you've had these, like going back to the Tollgate Highway, like hasn't been used for so long, there's no competitor because the main one isn't even been utilized. So yeah, there's no one. It's like one of my key kind of ideas of all of investing is you don't want to be somewhere where there's excess capex. Like, yeah, like everyone that argues the likes of Nvidia will maintain this beautiful moat. Like, that's just not the history of capitalism. Like, if you make a lot of money, people come for the crown, and generally they're pretty successful. So you want to be somewhere where you do have a nice moat and you can enjoy your moat for a while, but it will eventually get taken off you. Which is part of this game. Is nothing works forever. You've always got to keep moving on to new hated areas. If you get tied too much to one area, then you'll eventually get your ass handed to you if it becomes a religion. Yeah.
Yeah. Well, that's a lot. That's why we love it, really. We hang out in hate, and then when eventually we're loved, we realize we've got to find more hate again. Something
Yeah.
something to that effect.
Pretty much.
Thanks for joining me, mate. I really appreciate it. It was a great conversation. Guys, link to all of Trader Ferg's Substack, X account, etc. will be put in the description. Anything else you'd like to add, mate, before we sign off?
No, that's pretty much it. Yeah, I just think it's probably going to be a pretty volatile year. I kind of
Well, if January is any indication, yeah.
yeah, I agree with Luke Groman's take. He's just like, yeah, the numbers don't work for where the US finds itself, and so there has to be sort of a big print at some stage. And his only question really is it, do they just go to the big print, or do we need some sort of an event to force the big print? And so that's the only thing that concerns me. But granted, got a pretty heavy exposure to all the physical metals. Just have to take it on the chin, I guess, or maybe get some long vol exposure.
That is the question. If I remember correctly, I think Brad was buying some more strategic puts, and that hasn't crossed your mind. Haven't purchased any cheap
I wrote a
insurance.
whole piece on it. It's literally at the top of my list. I'm just always a cheap bastard and have limit orders. I haven't got the level that I wanted for vol. Could potentially be making a massive mistake by not just accepting like good vol rather than looking for ultra cheap vol. So that's something I'm really battling at the moment, is do I just bite the bullet and buy some with good enough but not crazy cheap? Whereas, yeah, I'm notorious for bites me in the ass a lot. Like, I see something that's cheap and I put a limit order 10, 20% below, and 2/3 of the time it works for me. And then there's 1/3 where I just have to painfully watch it for the next decade and take it off my ticker list and pretend it doesn't exist.
What does Uncle Rick say? Errors of omission and errors of commission. I don't know. I guess it could be worse. Another thing is that I know your portfolio and mine also, we really don't have a lot of exposure to the S&P or the Nasdaq.
No.
I've got like three basis points, 30 basis points, something like that, with Texas Pacific. So I guess in a liquidity crunch, everything can get smacked down a little bit, but
yeah, that's the thing. I don't know. I always just like it was one of the things Brad taught me early on was don't get too smart with thinking you can call like short-term moves and do a whole lot of options to time this sort of stuff. Like, I always look at some of the returns I get by just positioning super long term with a percent or two and sit back and accept the volatility on the way. Granted, there are times that's why I'm trying to be strict to get on the long vol traders. I'd like it to sort of stand on its own feet and make a lot of sense because I've got the vol super cheap. One to look at for everyone, if you can get a good expression, is how cheap the move index has got. It's, you're looking at like a volatility on bonds. You're looking at some of the cheapest volatility for decades. And so, yeah, then again, I'm not much of an expert at bonds, probably get my ass handed to me because it's outside of my circle of competence. But yeah, trying to talk to people smarter, like to see if I'm missing something there.
Okay, well, that seems interesting considering, fundamental setup would suggest there's quite a bit of volatility ahead for the bond market, but maybe we'll
Yeah.
discuss that at another time. Who knows?
Yep.
All right, guys, thanks for watching. I look forward to catching up with you in another episode. Make sure you check out Trader Ferg's Substack, links to the description. Take care, guys.
Cheers, man.